Numbers don't panic, people do. Let's look at the psychology driving today's market. You see others buying in, the price keeps climbing, and suddenly the fear of being left behind feels more urgent than any analysis. That impulse has a name. It is the fear of missing out. And while it feels personal, it is a crowd phenomenon, one of the most powerful forces shaping speculative market behavior. The question is not why individuals feel it. The question is what happens when thousands of investors feel it simultaneously and their collective response shapes the very market they are reacting to. There is a psychological principle called social proof. Under uncertainty, people look to the behavior of others as a guide for what is correct. If everyone is buying, buying must be right. When that principle operates inside a market, something powerful can happen. The participation of other investors becomes the evidence. Their buying replaces independent analysis as the basis for your decision. So we ask a specific question. When the crowd is buying, is the crowd's participation a signal of value? Or is it a psychological feedback loop that can sustain prices until the mechanism reverses? The observable pattern is recognizable. An asset begins rising. Early participants profit. Their success becomes visible. The visibility of that success attracts more participants who want the same outcome. Each new participant adds buying pressure, which pushes the price higher, which makes the early participants appear even more correct. The crowd validates itself through its own growth, reinforcing the signal. From a psychological perspective, this is social proof in action. The decision to buy is not based on independent evaluation of the asset. It is based on the visible behavior of other participants. And when many investors rely on the same social proof, the resulting buying becomes coordinated. The price rises not because the fundamentals improved, but because the crowd expanded. This is where the structural dimension matters. Social proof can interact with leverage, margin, and momentum strategies. When these structural forces amplify the psychology, the move can extend far beyond any reasonable valuation. The fear of missing out is the emotional expression of social proof under financial uncertainty. You are not afraid of missing a return. You are afraid of not participating when everyone else did. As Cialdini described, social proof is a psychological principle whereby people assume the actions of others reflect correct behavior, especially under conditions of uncertainty. It operates as a powerful driver of conformity. In markets, this principle can take on a unique dimension. The crowd's behavior is not just observed, it is measured. Price, volume, and participation are visible in real time, making social proof unusually precise. Notice the distinction. In daily decisions, social proof may guide you to a reasonable choice. In markets, the crowd's participation is the very force that can distort the price it claims to validate. This creates a reflexive structure. The more people buy, the higher the price. The higher the price, the more validated the buyers feel. The more validated they feel, the more others want to join. Bikhchandani, Hirschleifer, and Welch described this as an informational cascade. Individuals rationally follow predecessors rather than act on private information, producing conformity that can be inherently fragile and can reverse suddenly. The fragility is the key insight. The cascade looks stable because participation is continuous. But participation is conditional on the behavior of others. Remove the visible participation, and the entire structure can collapse. In market terms, this means the buying is not anchored to a valuation. It is anchored to the crowd. And anything anchored to the crowd inherits the crowd's instability. So social proof in markets does not just reflect sentiment. It can create the conditions for its own reversal. The mechanism that sustains the bubble also contains the seed of its fragility. Here is the feedback loop. An investor sees others buying. The visible buying serves as social proof that the asset is worth acquiring. The investor joins, adding to the very proof that attracted them. As the crowd grows, the price rises. The rising price generates attention. The attention brings in participants who were previously uninterested. Each new participant reinforces the perception that the opportunity is real. But the perception is circular. The opportunity looks real because people are participating. People participate because the opportunity looks real. Neither side of the loop is generating independent evidence of value. Schiller described this dynamic: speculative feedback loops where initial price increases generate enthusiasm that spreads through the investing population, amplifying stories that justify the increases and bringing in further investors. The narrative dimension is important. As the crowd grows, narratives emerge to explain why the price should be rising. These narratives serve as post hoc justification for what is fundamentally a social proof-driven movement. The narratives feel convincing because they appear alongside rising prices, but the narratives did not cause the rise. Social proof drove the participation. The narratives are the story the crowd tells itself afterward. Emotion can amplify the move. As prices continue rising, the fear of missing out intensifies. Late entrants are often the most emotionally driven, the least analytically grounded, and the most vulnerable to reversal. The structural dimension is critical. When late entrants use leverage, when margin increases, when algorithmic strategies pile into the momentum, the social proof-driven move becomes embedded in market structure. At this stage, the market is not pricing fundamentals, it is pricing participation. The crowd has become the signal. And when the signal is the crowd, the signal depends entirely on the crowd's continued presence. The cascade is inherently fragile because it rests on conformity, not conviction. The moment visible participation slows, the social proof weakens. When the social proof weakens, the cascade can reverse. Investors who bought based on others' participation now see others selling. The same social proof that drove the buying can drive the selling. The reversal can be sudden because the cascade was fragile. What sustained the price was not value, it was participation. When participation reverses, the price follows, often faster than it rose. The leverage and margin that amplified the rise now amplify the decline. Forced liquidations accelerate the selling. The structural forces that extended the social proof-driven rally now extend the collapse. Look. The speed of the reversal is itself social proof in the opposite direction. Investors see others exiting and interpret the selling as evidence that the opportunity was not real. The cascade flips. So the complete mechanism is: social proof drives participation. Participation drives price. Price validates the social proof, and the resulting structure is fragile because it depends on continuous conformity. But not every rising market is a social proof-driven bubble. Some price increases reflect genuine improvements in fundamentals, new technology, increased productivity, or structural shifts in demand that justify higher valuations. Social proof alone does not predict when a bubble will form, how large it will grow, or when the cascade will reverse. Timing and magnitude depend on structural and liquidity conditions beyond psychology. Consider that following the crowd can sometimes be rational. When information is genuinely limited and other participants have access to knowledge you do not, mimicking their behavior can be a reasonable strategy. The distinction is between social proof as informational shortcut and social proof as emotional contagion. When the crowd has genuine information, following is rational. When the crowd is following itself, the signal is circular. There are episodes consistent with this framework. When participation surges without corresponding fundamental improvement, and the market later corrects as participation reverses, the sequence fits the social proof model. But identifying this pattern does not provide a reliable method for predicting the reversal. The cascade can persist far longer than rational analysis would suggest, precisely because it is not driven by rationality. So the thesis holds within boundaries. Social proof can drive speculative dynamics, but the bubble is not purely psychological. It is conformity amplified by leverage and bounded by conditions psychology alone cannot predict. Which brings us back to the opening question. When the crowd is buying, is it signaling value or feeding a loop? From a behavioral perspective, participation can masquerade as evidence of value. Social proof turns the crowd's behavior into a substitute for analysis. The visible success of others replaces independent evaluation. And when the price itself is the only evidence of value, the valuation is circular. But this interpretation has limits. Not every crowd-driven rise is a bubble. Distinguishing genuine informational cascades from speculative feedback loops requires examining whether independent fundamentals support the price. The value of this framework is not in calling the top, it is in understanding the mechanism. Knowing that social proof can substitute for analysis does not tell you when that substitution will fail. Price is evidence of transactions, not a direct reading of emotion. A rising price can reflect genuine demand, new information, structural positioning, or social proof-driven participation. The price alone does not reveal the driver. What social proof reveals is one possible pathway to speculative excess. It does not reveal all pathways, and it does not provide a timing mechanism for when the cascade breaks. Awareness of social proof does not immunize you from it. You operate within the same market shaped by the crowd. The environment is the mechanism, and you are inside it. The FOMO-driven bubble is not caused by individual weakness. It is a structural outcome of social proof operating at scale, reinforced by leverage and narrative, and sustained until the cascade reverses. Social proof is one lens through which to understand speculative market behavior. It does not replace fundamental analysis, and it does not predict direction, but it reveals how crowds can create the illusion of value. Start by asking whether the buying is driven by fundamentals or by visible participation. If the primary evidence for the opportunity is that others are participating, the signal may be circular. Separate the narrative from the crowd. Ask whether the story justifying the price existed before the crowd arrived, or whether the story appeared only after participation made it convenient. Observe the behavior, not the prediction. Compare visible participation with independent value measures. If the valuation cannot stand without the crowd may be the valuation. Remember that recognizing social proof does not protect you from its market effects. The mechanism operates at the collective level, and individual awareness does not change aggregate behavior. This framework does not predict when the cascade breaks or how far the bubble extends. It explains why the bubble can exist and what sustains it while it lasts. Behavioral interpretation does not reliably predict price direction. Understanding social proof offers a way to study the crowd without claiming to know when or how the pattern will resolve. Social proof reveals how participation can substitute for analysis and how conformity can sustain prices. That is its contribution to understanding markets, a mechanism, not a forecast. Study the herd without following it. This is educational analysis, not financial advice, and behavioral interpretation does not reliably forecast market direction, magnitude, or timing. Social proof can turn participation into a substitute for value. Understanding that mechanism is the observation. Acting on it as a trade is not what this framework offers. Don't follow the herd. Study it. See you next time.